There is a common assumption in Silicon Valley that securing venture capital is the finish line, that once the ink finally dries on a massive multi-million-dollar term sheet, the trajectory is strictly upward. But external realities often intervene. Rising interest rates, compressed revenue multiples, or a freeze in market demand can abruptly halt a company's growth rate. When capital dries up and the cash runway runs short, a company may be forced to raise survival funds at a per-share price lower than their previous financing. This event is known as a down round. Pricing a round below the previous watermark immediately rewires the control dynamics and internal negotiating power of the entire organization. It is a critical vulnerability. The moment that lower price is accepted, it activates a series of defensive contractual mechanisms that most founders never plan to encounter. During early negotiations, founders are almost entirely focused on maximizing their valuation. They negotiate aggressively for the upside, often treating downside protections as boilerplate legal text. Experienced venture capitalists take a different approach. They structure their deals knowing that startups operate in extremes, engineering their contracts to endure catastrophic market failures just as efficiently as unicorn exits. The primary tool in that defensive arsenal is the anti-dilution provision. It is a legal shield designed specifically to trigger the moment a company's valuation drops. The mechanics are straightforward. If a startup raises new capital at a price lower than a previous round, the early investor's original conversion price is retroactively adjusted downward. As the MIT Sloan School of Management notes in its entrepreneurial finance curriculum, this dynamic operates on a simple golden rule. Those that have the gold make the rules. These legal provisions ensure that early investors maintain their influence and stake. The resulting financial shock is absorbed almost entirely by the founders and early employees. Investors typically use one of two mathematical formulas to calculate this price protection, starting with the more balanced and common weighted average approach. The weighted average factors in the size and price of the down round. The alternative, the full ratchet, ignores round size completely. The investor's conversion price drops to match the new price, protecting their exact ownership percentage while aggressively diluting the rest of the team. The high valuation a founder fought for in a previous round becomes the exact metric used to dilute them. Full ratchet provisions effectively weaponize a company's past financial success against its own creators during a moment of weakness. A down round triggers a secondary crisis that ripples directly through the internal team, impacting employee retention and compensation. As the company's valuation drops, the stock options issued to early employees suddenly have a strike price higher than the stock's actual market value. These options instantly go underwater, wiping out their theoretical financial value. To keep critical team members from quitting just when the company needs them most, the board is forced to react. They have to urgently reprice these underwater options to restore the financial incentive. Lowering that exercise price triggers strict 409A revaluation rules. This requires a new, heavily scrutinized appraisal, subjecting the company to a labyrinth of tax compliance and exposing employees to potential penalties. Building a resilient company requires looking past the optimism of a bull market. The strongest fundraising strategy is actively negotiating your deal terms to protect the company during its absolute worst-case scenarios. Before signing any term sheet, you have to ask how a halved valuation would affect your ownership. To help you build an investor-ready financial model that accounts for these variables, check out our $497 VC Funding Blueprint Kit, linked in the description below. Down rounds are severe, but they are not automatically fatal. The startups that survive brutal market shifts are the ones that planned for them long before the capital dried up.